Hi, hello, good evening, namaste to all of you. Is my audio clear to you? Yes, audio is clear. Okay, yes, perfect. Right, guys, since most of the students have joined, let us begin. Welcome to day two of Financial Management MCQ revision series. We have planned this series for 5 days. We have started it yesterday. Today's topic will be risk and leverage, and after that, cost of capital. Now, those students who were not present for live session yesterday, all these PPTs will be merged into one file and will be shared with you at the end of day 5. 5 days of MCQ revision will happen every day evening from 7 p.m. to 8:15 p.m. On day 5. Once we complete full syllabus, I'll be sharing all the MCQs in one single file instead of sending it on chapter wise or daily basis. I thought it will be better if I share one file to all of you in one go. Okay, all right. We are starting with risk and leverage. Everyone, if we are good to start, just give me a thumbs up in the chat box. All right, yes, here we are. Question number 1, risk and leverage. Dash is the ratio of net operating income before fixed charges to net operating income after fixed charges. First, please understand the question properly. What is the meaning of net operating income before fixed charges? That means they're talking about contribution before fixed charges. And next line says after fixed charges. That means they're talking about EBIT. Now, which ratio will connect contribution to EBIT? Is it DFL, DOL, or option C, operation leverage? This term itself is wrong. Option D also, term itself is wrong. Either we have DFL or DOL. Who can send the answer? Question number 1. Please, when you reply in chat box, do not just send option A, B, C, D. Send question number after that the correct option according to you. If you think answer is B, then send it in the chat box as 1B. Before that, please understand the question. Ratio of net operating income before fixed charges, that means contribution. After fixed charges, that means EBIT. Which formula connects contribution and EBIT? DOL. Option B. Most of you, perfect answer. Very good. Let's move on. Second, degree of dash is the ratio of percentage increase in earning per share to percentage increase in earning before interest and tax. They're talking about EPS and EBIT. This is purely about financial leverage. Understand? This is purely about financial leverage because question is EPS and EBIT. Everything below EBIT is all about finances, interest, taxes, preference dividend, earning per share, dividend per share. All of this is purely financial, not related to day-to-day business activities. Am I correct? That means the correct answer should be for question 2. Option D. Everyone? Yes. I can see in the chat box. Everyone is saying financial leverage, option D. Good. Let's move on. Question number 3. Go slow. Read and understand first. Operating leverage will be 1 if dash is 0. First, understand operating leverage. What is the formula? Contribution divided by EBIT. Now, operating leverage should be 1. That means contribution divided by EBIT. Both numbers should be same. If contribution is 5,000, EBIT should also be 5,000. That means in between, fixed cost should be 0. In between, fixed cost should be 0. Hope you are able to understand the question properly. Question number 3. Correct answer is option C. Everybody, I hope this is fine. Yeah. All right. Question number 4. EBIT is usually the same thing as EBIT means what? Day-to-day profits, operating profits, business profits. Correct? Option A says funds provided by operations. No. Earning before tax, that is EBT. That is EBT. Net income, definitely not. Net income is from EBIT, you have to take out interest and then you get EBT, then you pay off taxes. Correct? So net income is after EBIT. So correct answer is option D. Everyone? Question number 4, it's D. Yes. Chalo, perfect. Question number 5. Read properly. If operating leverage is 4, this means what? Understand, operating leverage connects sales to EBIT or contribution to EBIT. You can say either sales or contribution, because if sales go up, contribution also will go up. They are directly proportional anyway. Correct? Now question is, if operating leverage is 4, what does it mean? What is the correct meaning? For every 1% change in top item sales, there will be 4% reaction in EBIT. Remember, DOL, DFL and DCL is all about reaction for a change. For 1% change in sale, there is 4% change in EBIT. And which is the correct option? 1% change in sale, 4% change in EBIT. It should be B. Everybody? Good. Let's move on. Question number 6. The degree of, understand the question properly, total leverage. When they say total leverage, what does it mean? Combined leverage. Combined leverage connects topmost item to bottommost item. Which is the topmost item? Sales. Which is the bottommost item? EPS or EBT or EAT. Correct? All these are in proportion always. Yes, sir. Therefore, degree of total leverage is used to measure what? EPS to a percentage change in sales. Simple, understand. Topmost item to bottommost item. That's when you call it as total leverage. Total leverage is also called as what? Combined leverage. Correct? Hope you're okay with this. Yes. Let's move on. Question number 7. If fixed costs are too high or fixed costs are high, the operating leverage will also be, I want you to answer. If fixed costs are high, then operating leverage will also be high, low, zero, negative. What's the correct answer? Before you get into correct answer or wrong answer, understand fixed cost being high means it's high risky. Fixed cost is high means high risky. High risky should give you high benefits, high advantages. Benefits or advantages because you have taken some risk, and that's what you call as leverage. Remember fundamentals. Leverage is the advantage gained because you have taken some risk. If you don't take risk, you don't enjoy leverage. You want leverage, you should be ready to take risk. And having high fixed cost, my company has 10,000 rent. Your company has 20,000 rent. Definitely 20,000 rent is a higher burden than 10,000 rent, because it's a fixed cost. Even if there is a lockdown, I have to pay just 10,000, you have to pay 20,000, correct? So if the fixed costs are high, then operating leverage will also be high. More than high or low in number, understand the meaning. Fixed cost is high, that means risk is high. If risk is high, then advantage or leverage or benefit should also be high only. Correct? Yes, sir. Let's move on. Question number 8. High operating leverage indicates what? High favorable situation as it consists low fixed cost. Option A is completely wrong. If operating leverage is high, how can it be favorable? And it says as it consists low fixed cost. If there is low fixed cost, how will your operating leverage be high? Think, everybody. Second says highly risky situation as it consists of large interest cost. We are not discussing about interest cost. Question is about operating leverage. And when you talk about operating leverage, understand, in operating leverage, what should be the focus? Focus is business, day-to-day activity. Where is the question of interest? Interest is a finance cost. Third one, high favorable situation as it consists of high EPS. EPS is all far away. We are still discussing operating day to day. Option D, high risky, because it consists high fixed cost. That's the correct answer. Everybody, hope you're understanding. I can see in the chat box question number 8 almost everyone has given a perfect answer. Yes, yes sir. Let's move on. Question number 9. A firm has DOL of 4.5. DOL is operating leverage. What does this tell us about that firm? If sales go up, rise means go up by 4.5%, EBIT will rise by 1%. This is complete reverse answer. Option A is total wrong. Option B and C says EBIT rises by 4.5%. EBIT rises by 1%, and then they're talking about EPS. This question is not about EPS. We're talking about DOL. Sir, option D should be correct answer. 1% rise in sales, 4.5% rise in EBIT. Everybody, happening? Can I continue? In a way, this is covering even your theory revision. Yes. Right. So perfect. Question number 10. When a company has high amount of fixed interest charges. Now when you say interest charges, you are talking about financing. This is below EBIT. If you have high interest, that means you have high debt, high loan. Having high debt or high loan is high risky, correct? If it is high risky, then financial leverage should also be high. This is the basic thumb rule. If there is high risk, then there should be high return as well. Yeah, perfect. Let's move on. Question number 11. High financial leverage is not good as it indicates large content of fixed interest charges. Forget C and D, they're anyway wrong. Tell me what is the difference between option A and B? A says fixed charges, B says fixed interest charges. When they simply use the word fixed charge or fixed cost, they're talking about rent, depreciation, fixed salaries. When they say fixed interest charges, they're talking about pure financial item. Interest on loan, interest on debenture, interest on bonds. Correct? Both are fixed. Remember, rent is also fixed, interest is also fixed, but rent is a fixed operating cost, whereas interest is a fixed financial cost. Correct? Yes. Option B is the correct final answer. Let's move on. Question number 12. If return on investment is also called as return on capital employed. If ROCE is greater than rate of interest on debt, then it is said to be, think and tell me, favorable or unfavorable? If return on capital employed is more than rate of interest, it is favorable in nature, correct? Those who are not able to understand, think, I'm running a business. I have taken loan at 8% interest. 8% is rate of interest. Using that 100 rupee, I am doing 11% profit in my day-to-day business. That is called ROCE. That is called ROCE. Now take 100 rupee, make 11% return, and you pay only 8% interest. The difference becomes your profit. That means because of debt, you are earning extra money. You means owner. Owner means shareholder in a company. Now think about it. We are taking debt and paying them 8%. Using that money, we are earning 11% from day-to-day business, and that's called return on investment or return on capital employed. When from day-to-day business you can earn 11%, where the debt is only 8%. Having debt is good, having debt is advantageous, having debt is favorable. Correct? If you do too much of this, just because 11% is greater than 8%, remember in the regular class also we have discussed this. Yeah, if you do this too much excessive debt, then what happens? You are creating yourself a new financial risk, a pressure, correct, that may lead to financial bankruptcy. Able to recall this? So up to a level debt is good, but beyond that debt is not preferable. Yeah, let's move on. So correct answer is favorable when ROCE is greater than rate of interest. Chalo, question 13. High operating leverage combined with high financial leverage will constitute dash. Read properly. High operating leverage. When will this happen? If you have high fixed cost. High financial leverage. When will this happen? If you have too much of debt. Now combine both. Too much of fixed cost, too much of debt will increase your total risk. Will increase your total risk. That means it will create risky situation, high risky situation. Am I correct? Yeah. Perfect. Let's move on. Question number 14. Which of the following can be treated as least risky? High operating cost means day-to-day cost, and low financial leverage. Low operating leverage, high financial leverage. Operating and financial both should be low and both should be high. Question is least risky. Therefore, I will go by option C. Everybody, do you agree with me? If operating and financial leverage both are low, what does it mean? My day-to-day fixed cost is also low. My interest payable is also low. If both are low, then I am in a less risky situation. Think about it. Understand conceptually, don't mug up. Somebody is running a business with zero fixed cost and zero interest to be paid because no debt at all. Now think about it. No fixed cost, no interest. That means if this person sells the product at 1% above variable cost, enough for him. Suppose variable cost is 100 rupee. If he is selling it at 101 also, sales 101, variable cost 100, contribution 1 rupee, no fixed cost, EBIT 1 rupee, no interest, EBT 1 rupee, pay 30% taxes, then 0.7 rupee will straight away go to owners. Correct? That means all that he has to do, sell the product at a price higher than variable cost. Sir, what if there is 100% lockdown? What happens to his income statement? Sales zero, variable cost will also be zero. Anyway, fixed cost is not there. Anyway, has not taken debt. Everything will be 0, 0, 0, 0, 0. That means he is the safest guy. That's why question says least risky is when you have low fixed cost and low interest. Yeah, perfect. Good. Yes, let's get into some practical sums. All those who did not attend previous MCQ sessions, I want you to have pen and rough paper with you and calci, and I want you to participate, work out the sums. Let's discuss. Yeah. Output in units 3 lakh, fixed cost given, variable cost given, interest cost given, selling price, tax rate. Calculate financial leverage. Understand, before you write full income statement from top to bottom, they want financial leverage. For financial leverage, what and what you need? EBIT by EBT. EBIT by EBT. That means this tax information is of no use to me. Correct? They have not asked you to do EPS. They're not asking you to calculate earning available to equity shareholder. Question is simple. They want DFL. That means I need EBIT divided by, I need EBT. Yes, sir. Tell me how to reach EBIT. You have sales with you. First in Calci, do selling price minus variable cost. 3 rupee minus 1 rupee, that is 2 rupee. 2 rupee into 3 lakh, 6 lakh is contribution. From that you take out fixed cost. From that you take out interest. You reach EBT directly. I think the final answer should be 1.1. 1.1. Are you getting the number? Saujanya, why option C? Please recheck. They're asking you financial leverage. They want EBIT by EBT. Yeah. Everyone, option A is correct. Can I continue? Yes, sir. Let's move on. Question 16. I think data is same. 3 lakh output, fixed cost given, variable cost, interest, tax rate. Now the question is to calculate combined leverage. Be careful. When they ask combined leverage, they want top to bottom. Correct? That means they want contribution. They want EBT. Correct? You can even do DOL first, DFL next, and then multiply, but that is lengthy. When you know contribution by EBIT is DOL, EBIT by EBT is DFL, you can cancel EBIT, EBIT. When you do into multiplication, it can simply be contribution by EBT. Go ahead, who can answer? Question 16. You need contribution and you need to divide that by EBT 2.67. Most of you are getting same answer. Yes. Yeah. Good. Question number 17. Yes, please. Operating leverage is 2.1429. Financial leverage is 1.0699. Then combined leverage will be dash. Now tell me, combined leverage is DOL into DFL. And when you have both information, it is simply the multiplication that you have to do. Correct? Give a try. Who can answer 17? 2.2927. Can I take this? It is simply multiplication, right? Why is there a confusion? Many have given same answer. Option A. Yes. Simple, DOL into DFL. Yeah. Question 18. This you go slow. Combined leverage is 2 and financial leverage is 1.25. Then operating leverage will be dash. Please understand, combined is given, DFL is given. That means I should not now multiply. Be careful. Combined is equal to DOL into DFL. Yeah, I think you'll have to do 2 divided by 1.25. Am I correct? It won't be multiplication now. If you want to write formula, remember DCL is equal to DOL into DFL. Correct? Therefore, to get DOL, I should do 2 divided by 1.25. Correct? Yeah. Perfect, sir. Option C. Many have given the correct answer. It is 2 divided by 1.25. Yes. All right. Question number 19. I will wait for you to try. Operating leverage is 4. That means 10% change in sales will cause. Understand, this is operating leverage. That means this will connect sales to contribution to EBIT. All of this is your day-to-day business. And remember, if sales go up, contribution both will go up at same 10% because in between you have only variable cost. But what will change more than proportionate is EBIT. So if it is 10%, then it should be 40% reaction. Correct? So the correct answer for 19th question is D, 40% change in EBIT. Some of you are giving wrong answer, guys. Understand, 1% change is equal to 4% reaction. If there is 10% change, it will be 40%, correct? 10 into 4, 4 times reaction. Yeah. Right, sir. Question 20. Yes, good question. Question 20, you have to go very slow. If there is 10% increase in sales, EBIT will increase by 35%. And if sales go up by 6%, taxable income means what? Profit before tax, PBT, that will increase by 24%. Question is operating leverage must be dash. Understand, operating leverage is about what? Change in sales and change in EBIT. Correct? That means I should only consider this 10% increase in sales, 35% increase in EBIT. Sir, you should simply do 35 by 10. Correct? 3.5 is the answer. Sir, the taxable income 24%, sales 6%. What is all that? That is change in sale and change in EBT or PBT. That is not operating leverage. Are you understanding? That's not operating leverage. All okay? Yes. Let's move on. Question 21. Operating leverage is 7, financial leverage is 2.258. How much change in sales will be required to bring 70% change in EBIT? Very good question. Go very slow. First read and understand. Operating leverage is 7, financial leverage is 2.28. How much change in sales will be required to bring 70% change in EBIT? That means question is change in sale and change in EBIT. Change in sale and change in EBIT is all about DOL. Correct? And what is the meaning of operating leverage? 7. For 1% change in sales, there is 7% change in EBIT. All okay? And they want 70% change in EBIT. That means it should be a cross multiplication. And I think it will be 10%. Am I correct? Yes. Read properly. 1% change, 7% reaction. I want 70% reaction. What should be the change? A simple cross multiplication. Yes. Done, sir. Question 22. Then the question. I want all of you to solve this. Yeah. This can be a 2-mark MCQ. Read first. Total assets of the company 3 lakh rupee. Company's total asset turnover ratio is 3 times. When you read, what you should process? Assets are 3 lakh. Asset turnover ratio 3 times. What is the meaning? 3 lakh asset turnover will be 3 times. Everybody, turnover will be 3 times. That means sales 9 lakh rupee. Am I correct? Am I correct? 9 lakh rupee. And then they said fixed operating cost, that means day-to-day expenses fixed 1.5 lakh, and variable cost ratio 50%. This 50% is to be applied on what? Sales, because variable cost is a cost that is connected to sales. If sales go up, variable cost also will go up. Therefore 9 lakh was sale. On that 50%, if you apply, variable cost is 4.5 lakh. So contribution comes to 4.5 lakh. In that 1.5 lakh will go as fixed operating cost. Then you are left with EBIT 3 lakh. Guys, I am doing without calci. See here, my both hands are free. You should be able to do it faster than me. 3 lakh into 3, 9 lakh sales. 50% variable cost 4.5. So contribution is 4.5 lakh minus 3 lakh fixed cost. Sorry, 1.5 lakh fixed cost. Therefore, EBIT 3 lakh. Am I correct? And then they said income tax rate 50%. Before that, the firm has a long-term debt of 1,20,000 on that you have to pay 10% interest. That means another 12,000 will go. So now you have interest. You get EBT. Now stop. You don't need that income tax rate information because question is DOL, DFL and DCL. Correct? Whenever you have questions like this, observe DOL you first do. That comes to 1.5. Am I correct? That means final answer should be either option A or option C. Yes. After that you check financial leverage. I think you're getting 1.42. 1.42. And now you don't have to even do combined leverage. Only option C. Sorry, option A 1.042. Sorry, my mistake. 1.042. Therefore, only option A has correct combination of 1.5 and 1.042. I think final answer should be option A. Are you with me, everybody? Can I continue? Yes. Question 23. Contribution given, EBIT given, 10% debenture given, combined leverage is equal to question mark. Yes. Combined leverage is the question. See if you can do it directly. Even last question, we could have directly calculated combined leverage and check out of 4 options which combined leverage is correct. And then you can eliminate wrong answers. Correct. 23rd question, they're directly asking you combined leverage. Try how to do combined leverage. Contribution by EBT. Sir, 4 lakh numerator. Denominator will be 3 lakh EBIT minus 60,000, 2 lakh 40,000. So 4 lakh by this, I think 1.66. Are you getting the correct answer? Everybody? 23B. Good. Yes, sir. Let's move on. Question 24. EBIT given, fixed cost given, interest given. Question is combined leverage. I want you to try this. Guys, to do combined leverage, you need contribution by EBT. Now, how to reach contribution? Sir, I have EBIT 4 lakh. I have fixed cost 6 lakh. So, if I do add back 4 lakh plus 6 lakh in reverse order, I can reach 10 lakh. Am I correct? I can reach 10 lakh contribution divided by EBT. For EBT from 4 lakh, if I take out 80,000, I'll be left with 3 lakh 20,000. Am I correct? I guess the final answer will be 10 lakh by 3 lakh 20,000. And that comes to 3.125. Everybody good? I can see many have the same answer. Yeah. Perfect. Guys, is my speed okay? Reply in the chat box. Is my speed okay? If you have any concern, let me know in the chat box. Is my speed okay to all of you? Yes? Okay, let's move on. Question 25. Chalo, perfect. Question 25. Contribution of a firm is 4,000 rupee. Fixed cost. Case A, B and C. 3 cases given. Compute the operating leverage for 3 situations. Now to do operating leverage from contribution, correct, divided by EBIT. For EBIT it will be 4000 minus 1000. Yeah, so that will be 4000 divided by 3000. Next one is 4000 by 2000. Last one is 4000 by 1000. Yeah, looks like option D is the correct answer. Option D is the correct answer. Hmm. Guys, just observe in exam, suppose you don't have time. I'm saying suppose you don't have time and this MCQ you have hardly 10 seconds to complete. What you can do, look at the last option, 4000 contribution, 3000 is fixed cost. What is left out? Only 1000. So 4000 by 1000 it should be 4. Only option D has 4. Just take that. Able to follow? Yeah, if you have time, do the calculation properly. If you don't have time, then you should find out. By practice you will get to know. Yes. Option D has to be the correct answer. Yes sir. Question 26. Give a try. Following data is available for Alpha Limited. Financial leverage 2:1 means 2. Operating leverage is 3:1, that means 3. Interest 20 lakh rupee. Tax rate 40%. Variable cost as a percentage of sale 60%. Sales question mark. Very good question actually. This should be minimum 2 mark MCQ. It takes a lot of time. Go slow. Whenever you are stuck with question like this, observe which is the only number available in rupee. Sir, 20 lakh rupee interest. Correct? Everything else is either ratio or percentage. And that is interest. And they have given financial leverage 2:1. Correct? And financial leverage is EBIT by EBT. This they are saying 2 by 1. That means if this is 2x, this should be 1x. And between EBIT and EBT, the only thing possible is interest. Correct? So now you can do 2x minus 20 is equal to x. From there you can work out the equation. You will get the value of x, and that value of x will be EBT. Can somebody message me in the chat box? If you do it in the style that I told you, 2x minus 20 lakh is equal to x. How much is EBT value? How much is x value? Anybody? How much is x value? I think x value will also be 20 lakhs. Yes. Reply in the chat box. How much is value of x? 20 lakhs. Yeah. So if this is 20 lakh, now go in reverse order. EBIT will be 40. Correct? And then you have operating leverage 3:1. That means above this your fixed cost, above that it should be contribution. And if this is 3, then this should be 1. From cross multiplication, you will get to know this I think is 120 happening. If this is 120, then this should be balancing figure 80. And variable cost is 60%. That means contribution is 40%. So if 120 contribution is 40%, now is 100%, that should be sales. I guess the final answer is 3 crore rupee. Guys, you can do this in many different style. If you do not get any variety in any style, you're not able to get the flow. In exam, you can substitute the numbers and see. Start from top, 1 crore sales, take out variable cost 60%, contribution will be 40%. From there, using DOL, put the fixed cost. Then you see whether if you put interest, DFL is matching or not. If not matching, then 1 crore is wrong answer. You don't get any style, reverse working style, formula method, keeping it as X. You're not getting anything. You at least substitute all 4 options. No, that's the easiest way. Yeah. Can I continue? Yes. Question 27. Following data is available for X Limited. Variable cost as a percentage of sale 70%. Interest given, DOL, DFL, tax rate. EBIT is the question. EBIT is the question. Similar to the previous one, you have interest. DFL is 3x minus 20,000 is equal to x. From there you can get the value. I think this is much easier. Can you confirm? Is final answer correct? 27A. 27. Is it 30,000? If you're getting a different number, let me know. Is it A? I can see now one by one students are sending option A, 30,000. Guys, this is similar to 26th. You just have to do reverse working. Yeah, and tax rate is not relevant. All our leverage formulas are up to earning before tax. Tax will come below EBT. Why should we worry about tax? Yes. Let's move on. 28. I think similar question. Give a try. I will wait for you. 28th question. Give a try, everyone. Variable cost as a percentage given, interest expense given, DOL, DFL, contribution. Now using interest, using DFL, you find out EBIT, and from there using DOL 6x, you can start from that way. You will be able to find out contribution value. Are you getting 2,40,000? Anybody? In the chat box, I can see. Yes. Good. Many are getting 28B. Yes. Can I move on? Yeah. Guys, if anybody is not getting the answers, you can put your doubt in the comment section once the live video is over. Those who are watching in future, those who are not live today, if at all, if you get any doubt, you can send your doubts in the comment section. I'll reply. Yeah. All right. 29th. Yes. Total assets of Honeywell Limited 6 lakh rupee. Total asset turnover is 2.5 times. That means if you do 6 lakh into 2.5, you will get total sales. Fixed operating cost is 2 lakh. Variable cost 40%. Tax rate is 30%. Calculate operating, financial and combined leverage assuming no debt. Fantastic. Now hold on before you start. Question is DOL, DFL and DCL. When there is no debt, that means there is no interest. If there is no interest, EBIT, EBT, both numbers will be same. EBIT, EBT, both will be same. If both numbers are same, then DFL, financial leverage, will be 1. DFL will be 1. Which option has 1? Option A and then option D. That means one of the two should be correct. Hope you are following. Now the only thing, sir, I have to calculate is, look at this. Option A also 1.2857. Option D also 1.2857. Sir, I think I already know the answer. How? Sir, if the financial average is 1 and degree of operating is 1.2857, how can combined be 1.3314? This option itself is wrong. Guys, you actually don't have to solve anything in this sum. I hope you're understanding what I'm saying. There is no need of pressing calci. If financial leverage is 1, combined leverage should be equal to operating leverage because you're doing a number into one. When you do a number into one, it should be same number. Am I correct? Simple answer. It has to be D. Yes. Question number 30. Total assets of the company 6 lakh. Asset turnover ratio 2.5 times. That means 6 lakh into 2.5 will give you turnover. Fixed operating cost given 2 lakh. The variable operating cost is 40%, tax rate 30%, number of equity shares given, determine the likely level of EBIT if EPS is 6 rupee. Please understand, don't start from top. Observe what they have asked. Likely level of EBIT if EPS is 6. Now I am working out here. They want EBIT, correct? From that I have to pay interest. Please check. Is there any interest related information in the question? First line says asset, then turnover, then fixed operating cost, variable cost, income tax, equity share, nothing. That means, sir, there is no interest. So I have to calculate EBT. Yes. And then from EBT, I have to minus tax. Tax at what rate do we have? 30%. Okay, this will give you EAT. There are no preference shareholders, correct? This itself is earning available to equity shareholder. How to calculate this? They want 6 rupee already given, and then there are 18,000 equity shares they said. That means in calci 18,000 into 6. Anybody? 18,000 into 6? 108,000, is it? Yes. This should be 108,000. Yeah. And tax is 30%. That means, sir, if this is 100, this is 30, this is 70. Simple cross multiplication will give you the final answer. Option A, 154285. Now we observe you don't have to start from top. They've only asked EBT. Yeah, sorry, EBT or EBIT. I read it as EBIT. Anyway, they've asked EBT. Since there is no interest, anyway, both are same. Yeah, chalo. Final answer is 154 to 86, option A. Yes, sir. Question 31. Calculate DFL for a firm when EBIT is 20 lakh. Firm has 30 lakh in its debt that will cost them 10%. So this is about interest. Firm also has 9%, 10 lakh preferred stock. Preferred stock means preference share. Preference share. Firm will pay 40% taxes. The question is DFL. By the way, DFL is all about EBIT divided by EBT. So doesn't matter how much is tax rate. It doesn't matter how much is preferential capital also. Correct? Sir, EBIT 20 lakh. I have to take out 3 lakh interest. So it is simply 20 lakh by 70 lakh, 17 lakh. I think the final answer is 1.24. Do you agree? Everyone? Can I continue? Yes. Guys, please confirm. I am waiting for you. Is the answer 1.24? You guys are getting 1.17, is it? Okay. No problem. Yes, I think this should be 1.17. Done. Yes. So 20 lakh 30 minus this is all right. I think you're correct. 1.17 is the correct answer. Let's move on. Guys, please recheck once what's the correct answer. Some students are saying 1.24. I think 1.17 is correct answer. Yeah, yeah. 1.17 even I did in Calci. Yes, 32. Lower financial leverage is related to use of what? Observe, observe, observe. If you go fast, it's a dangerous question. If you have low financial leverage, that means you have very less interest. If you have very less interest, that means you have very less debt. If you have very less debt, then from where are you getting money? Sir, it should be coming from equity. That means you are using additional equity. Equity means common. There is no preference given, no preferred stock. It's a common stock. That means answer should be D. Yes. Let's move on. 33. Operating leverage indicates the impact of change in sales. Operating leverage. Sir, they are talking about top items, correct? Change in sales on change in what? Profits. Day-to-day income. Day-to-day income is operating income. Correct? It should be option A. Option A. Change in sales. Change in profits. Profits here mean day-to-day profits. Operating profits or operating income. 34. Which of the following statement is correct? Let's see one by one. If a business firm has lot of variable cost as compared to fixed cost, then the firm is said to have high operating leverage is wrong. Because if you have too much of variable cost, then it can't be high DOL. Yeah, that is wrong. Combined leverage is percentage change in EPS multiplied by, no. It is not multiplied by. When you're doing percentage change, remember, this percentage change divided by percentage change. It is not multiplied by. I hope there is no confusion. Third one. If a business has too much of fixed cost compared to variable cost, then the firm is said to have high DOL. This looks correct to me. However, I'll see what is there in option D. If contribution is less than fixed cost, guys, if contribution is less than fixed cost, you are in loss. Then operating leverage will be favorable, and no, that can't be correct. Option C is the correct answer. Option C is the correct answer. Yes, sir. 35. A firm has a DFL of 3.5. What does this mean? DFL is about financial things. Then I should not read option A and option D. Both are about sales. DFL is not about sales. Yeah, option B and C, if you read, looks like option C is a better answer. If EBIT rises by 1%, EPS will rise by 3.5%. Yeah, yes, sir. I think option C is the correct answer. Everyone, are you with me? Yes. All good? Perfect. With this, 35 MCQs from risk and leverage is done. Yeah, let's move on to our next topic for the day, cost of capital. Are we good to start? Yes. Read. Cost of capital is used as dash in determining present value of future cash flow associated with a capital project. Discount rate, premium rate, present rate, and none of the above nota. Please understand, cost of capital is used as discount rate in capital budgeting class. NPV, we need year 0, 1, 2, 3, 4, and then cash flow, that is multiplied by discounting factor. Discount rate is nothing but overall cost of capital. Cost of funds, remember WACC, overall cost of capital, any of that. Yes, sir. Correct answer is A, discount rate. Chalo, let's move on. Second one. The financial manager must take careful decision regarding cost of capital because it is closely associated with the value of the firm and the earning capacity of the firm. 100% true. 100% true. Because value of the firm is inversely proportional to cost of capital. If cost of capital is less, value of the firm is high. Therefore, you have to be very careful in choosing the source of fund. If your cost of capital is less, then only your business valuation will rise. Yeah. Question number 3. Long-term finance involves financing for fixed capital requirement for investing in fixed asset. Perfect statement. Understand, when I say long-term financing, what does it mean? Share capital, reserves and surplus, debentures, bonds, bank loan for 3, 5, 10, 15 years. And that money should be used for what purpose? Day-to-day purpose? No. A long-term fund should always be used for long-term asset creation. Understand, in classroom also we have discussed this many times. If I'm planning to purchase a house, and if the life of that house, that building, is 30, 40, 50 years, then my housing loan duration should also be 20, 30, 40 years. Correct? A long term asset should be funded by a long term liability, and vice versa. If I need money for next 2, 3 months, I should not take a 10 years loan. I should take a loan to be repaid in 6 months or 1 year. Able to follow? Yeah. Good. Question number 4. Which of these is a feature of long-term finance? First, it is obtained from shareholders, bankers, capital market. True. Generally used for financing big projects. Correct. Involves financing for investment in long-term fixed asset. Just now I told you, sir, all of the above. All of the above. Because we are talking about long-term funding. It should satisfy all 3 criteria. Yeah. Question 5. Retained earnings fall under the category of owner money, borrowed money, both A and B, none of the above. Understand, retained earning is all about reserves and surplus. Who owns reserves and surplus? Who is the owner of reserves and surplus? The same guy who owns equity share capital. That means this belongs to the owners of the company. Who are the owners of the company? Shareholders. In that, specifically equity shareholders. That means retained earnings are part of ownership capital. Yes. Right. Question number 6. Debentures may be convertible or non-convertible. Perfect. True. True, true, true forever. Convertible debentures. What does it mean? You purchase company's debenture. You will earn interest for 3 years, 4 years, 5 years. After that, you will be converted into equity share. That means an option can be given to the debenture holder. If he is willing to become a debenture holder, he can, sorry, if he is willing to become an equity shareholder, he can do so, provided today he purchases a convertible debenture. Yes, right, sir. Question 7. The cost of capital is required rate of return that a firm must achieve in order to cover the cost of generating funds in the marketplace. 100% true. What is the purpose of knowing cost of capital? KO, cost of overall capital. Why I should know? Because that is the minimum rate of return that I should earn from my day-to-day business. Correct? Yes. Guys, I am not sweating because questions are difficult. I am sweating because it is 40-degree in my native today. 40-degree in my native today. Yeah. Is it same even in your place? 36, 38, 40, almost everyone. Most of you, I can see in the chat box. Yeah. All right. Question number 8. If a firm fails to earn a return at the expected rate, the market value of the shares will fall and it will result in reduction of overall wealth of the shareholder. Perfect. True. Understand, if company is not generating enough profits, what will happen? Shareholders will not be happy. And if shareholders are not happy, they will start selling the shares. And if too many shareholders sell the share, what will happen? Selling price of the share will come down. Market price, market value will come down. And if market value is coming down, shareholders' wealth will go down. 100% correct sentence. Yes, sir. Let's move on. Question 9. Cost of debt is calculated using dash formula. KD is equal to I into 1 minus T. 1 minus T, correct? I think option C, 1 minus T, because you pay and you save taxes. You pay interest, because of that you save taxes. Correct? Guys, tell me, if I go by option D, I into T, this will give me what? I into T will give me what? This will give you tax savings. This will give me tax saving. Am I correct? Suppose tax is 40% and I'm paying 10 rupee. Then 10 into when I do, what I get is tax saving. Yeah, they have not asked you tax saving. They have asked you cost of debt. So it should be 1 minus T. Right. Question number 10. If cost of debt is 10% before tax, so this is I. And if tax rate is 40%, then cost of debt after tax will be, tell me what to do. Sir, amount is not given. On what should I apply 10%? Why do you need amount? If you want, you consider 100 rupee. You consider 100 rupee, what's the problem? So 100 into 10%, 10 into 1 minus 0.4, that will become 0.06. So answer will be 6%. Yeah. Some students are saying there is a lag in video. I hope it is proper now. Can you please give me a thumbs up if everything is okay? Yes, I think we are good to continue. All right. So question number 10, correct answer should be 6%. Correct answer should be 6%. If you are not able to get the answer directly from 10%, you assume debt value is 100 rupee. What happens now? 100 into 10%, 10 rupee. Correct? So 10 rupee into 1 minus T. So 10 rupee into 1 minus 0.4, 10 into 0.6, that will come to 6%. Yeah, let's move on. Question 11, give a try. D and company sells a new issue of 6% irredeemable debenture. If it is irredeemable debenture, what does it mean? Forever you pay interest. There is no question of redeemable value. Yes, to rise 1 lakh rupee and realizes the full face value of 100 rupee per debenture. Company falls in 40% tax bracket. Debt is issued at par. Find out cost of capital. Understand, if there is no redemption adjustment in the question, if there is no redemption adjustment in the question, then I simply have to do I into 1 minus t divided by net asset. And here they said it is at par. That means I have to simply do 1 lakh into 6%, 6,000. 6,000 into 1 minus t. That should be divided by simply 1 lakh rupees, sir. I think it is 3.6%. Straight simple question. There is no discount, no premium, no par value, no redemption adjustment, nothing. It's the easiest question. Easiest question. Yes. A good question is this one. Question number 12. R and company sells a new issue of 6%, 100 irredeemable debentures of rupees 100 each at 10% premium. Therefore, today when you issue, you are not getting just 100, you're getting 110 rupee, 100 plus premium. Company falls in 40% tax bracket. Find out cost of capital. Now tell me, numerator will be interest 6 rupee, correct, into 1 minus tax, 1 tax, 1 minus 0.4 to be divided by, tell me what. So now don't divide by 100, you have to divide by 100 plus premium. This should be divided by 110. Are you with me? If I divide this by 110, anybody final answer? 3.27%. 3.27%. Yes. Are saying there is a lag. So just give me 1 minute. I will disconnect and reconnect. Just be there. Yes. Yes. Is it okay now? Can you please confirm? Yes. Question number 13. SN company sells new issue of 6%, 100 irredeemable debentures of 100 each. Now 100 debentures, 100 rupees. Remember, at 10% discount. The company falls in 40% tax bracket. Find out cost of capital. Many have already completed the answer, is it? Many are saying option B. Guys, understand, you have to pay 6 rupee interest, 40% saving in tax. So that will be 6 into 1 minus 0.4. I think you'll get 3.6 to be divided by 100 rupee but 10% discount. So denominator will be 90. All okay? Can everybody confirm now? Is it 4%? Is it 4%? Yes. Yes. Question number 14. A firm issues debentures worth 1 lakh rupee and realizes 98,000. Indirectly, what does this mean? Indirectly, it means, sir, we are getting 2,000 less. That means you should understand you are giving it at a discount. Yes. They carry an interest rate of 10% and are due for maturity at the end of 10th year. Okay, sir, this is a question with redemption. Please read, everyone. It says due for maturity at the end of 10th year. Now this cannot be simply I into 1 minus t. Be careful. What should be the correct formula now? I into 1 minus t plus there is that RV minus NR divided by N. Hope you can recall. Yes, sir. The company has 40% tax bracket. KD is equal to what? I'm working out here. First of all, how much will be interest you have to pay on full 1 lakh? Doesn't matter whether you issue it at par premium discount, it should be on full 1 lakh value. 98 may be issue price, but then interest will be on full amount. Yes, sir. So this will now be 1 lakh into 10%, 10,000 into 1 minus tax rate 40%, or plus we are going to redeem it. If nothing is given, then redemption will be at par. That means redemption money will be 1 lakh. Today you are collecting only 98,000. This will be a loss. After how many years? 10 years. Therefore, I have to divide this by 10, so I'll get to know annual loss. Everybody, denominator is average, that is 1 lakh plus 98,000 divided by 2, sir, you should take 99,000. Correct. You should take 99,000. What is the final answer? Everyone is saying 6.26. 6.26. Is this correct? Option D. Yes. Yes, sir. 6.26%. Let's move on. Question number 15. X Limited issues its bond at 1,000 rupee par value. These bonds will mature after 20 years, again at par only. It bears a coupon rate. Coupon rate means interest rate, 10%. Coupons are annual, that means interest is paid once in a year. Bond will sell, that means issue at par, but there is flotation cost of 50 rupee. That means you are not going to get full 1,000 rupee, you will get only 950 rupee, correct? You have to minus this 50. Yes, sir. Per bond, tax rate 30%. What is after tax cost of bond? Again, it is with redemption adjustment. Interest will be 1,000 into 10%, 100 into 1 minus tax rate, 100 into 1 minus 0.3, yes, plus Understand, redeemable at par value 1000, but today you are not getting 1000, you are getting only 950. That is, the difference should be understood as loss. 1000 minus 950 is the loss, but this loss is not 1 year loss. This loss is over a period of how many years? 20 years. When your interest is per annum, tax is per annum, even the loss should be on per annum basis. Otherwise, comparison will be incorrect. Whole divided by 1000 plus 950 divided by 2. I think that comes to 975. Yes. Therefore, our final answer is 7.43%. Everybody, can I take this as a final answer? Yeah. Done, sir. Let's move on. Next, question 16. Preference dividends are not allowed as expense for the purpose of taxation. 100% true. No doubt in this. Only interest is allowed. Preference dividend, equity dividend, both are not allowed. Both are not allowed. Yes, right, sir. Question number 16, answer is A. Next, question number 17. A limited company issues 8% preference shares. Face value of the share is 100, but they are issued at 105. Flotation cost is 3 rupee. Calculate cost of capital. They haven't given anything about redemption. That means I have to consider only preference dividend divided by net receipt. How much is preference dividend? 8%. Correct. 8% is on what? 100 rupee. That means I have to take it as 8 rupee to be divided by 105 minus flotation cost 3 rupee. That means it is simply 8 divided by 102. Please go slow. 8 divided by 102, not 105. You have a flotation cost that should be deducted. Can you please recheck? 8 divided by 102. Answer is 7.84%. Some of you are doing a mistake because you're taking 105. Yeah, you are issuing it at 5% premium, agreed, but there is flotation cost 3 rupees. So what comes to you? Net receipt is only 102. Yes, perfect. Let's move on. Next, question 18. The formula for cost of redeemable preference share. Redeemable preference share is represented by 4 options given. First of all, D should be dividend. D plus, that is dividend plus loss on redemption. If you see option C and D, both are saying D minus. That means C and D is wrong. It should be A or B. Let me read A properly. D plus RV minus NR divided by N. RV minus NR will tell you what? Redeemable value minus net receipt by N will tell you annual loss on redemption or gain on redemption. To be divided by RV plus NR by 2, it will give you average value. That means option A is the correct answer. Do you agree? A is the correct answer. Sir, B also looks similar. Correct. But look at B properly. It is NR minus RV. That's not true. It should be RV minus NR. Yeah. Right, sir. Question number 19. I want you to try this. Everybody. Question number 19, please. I will wait for your answer. It says a company issues 10,000 8% preference shares of 100 each, redeemable after 20 years at face value. That means it is with redemption. Question, be careful. Flotation cost is 3 rupee. Cost of capital, not case of capital, cost of capital. How to do? 8% preference share of 100 each. That means dividend will be 8. Redeemable after 20 years. Flotation cost is 3 per share. Correct? That means today you are only going to get 97 rupee, whereas you have to redeem full 100 rupee. So 3 rupee is the loss, but that should be divided by 20 because you want average liability. Sorry, you want annual loss. That is to be divided by average 100 plus 97 by 2. Yes, who can send me the answer first? Don't do 1 minus t. It's a preference share. There is no tax saving. There is no tax saving. It's not debenture. It's not bond. Many are saying option A, 8.2%. Can we take that? Can we? Yeah. Good. Yes, sir. Question 20. Formula for capital asset pricing model. By the way, 19th final answer is 8.2%. Question 20. Formula for CAPM. KE, cost of equity, is equal to RF plus RF is risk free into beta. Actually, our formula in study material is beta into RM minus RF, which is same as RM minus RF into beta. Either you say 8 into 1 or you say 1 into 8. Both are same anyway. Yes, sir. Option A should be the answer. RM minus RF into beta. RM is market rate of return. RF is risk free. Do you remember RM minus RF was called risk premium? Yes. That itself is question 21. Market risk premium is represented by RM minus RF. RM minus RF. RM is market rate of return. RF is risk free. Compared to risk free, how much extra am I getting if I invest in market? That's why it's called market risk premium. Hope you're understanding. Yes. Next one. Question 22. Calculate the cost of equity for a company whose risk-free rate is 10%. Equity market rate of return is 18% and beta value is 0.5. Beta value 0.5. So what to do? This is CAPM question. Our first RF 10%. Correct. Start with the 10 plus beta 0.5. Open bracket 18 minus 10. 18 minus 10 will be 8. 8 into 0.5, 4. So 10 plus 4 should be, I think, 14%. Can you confirm? Are you getting 14%? Yes. Happening. Done. Question 23. A company has issued 5,000 equity shares of 100 each. Its current market price is 95. Current dividend is 4.5. The dividends are expected to grow at 6%. Everyone be careful. This sentence is current dividend. That means this is D0. Am I correct? This is current as of now 4.5. Dividend is expected to grow at 6%. By the way, you want D1 in your formula. You want D1, am I correct? Everybody? Now to get D1, I can't take 4.5. I have to take 4.5 plus 6%. Yes, sir. To be divided by 95. Since there is growth, you have to separately add another 6% as G. Hope you can recall this formula. Cost of equity is equal to what? D1 by P0 plus G separately, because this represents perpetual growth. That means first I have to do 4.5 plus 6%. Yeah. Divided by 95 plus separate G, that 0.06, which is 6%. Don't take 0.6. 0.6 is 60%. Very talented. 0.06 is 6%. Yes, sir. 11.02 is the final answer. Yeah. All right, guys. We will do few more MCQs on cost of capital in this session. If you are not able to complete full cost of capital, we will be doing balance cost of capital in the next session. Don't worry. Okay. I'm not going to reduce the number of questions. We will do few now, 5 more minutes, and then few more questions. We will be doing it in the next session itself. Okay. Yes. Question 24. Give a try. Company has 10,000 equity shares of 100 each. Earnings are 1,50,000. Very important. It is earnings 1,50,000. Current market price is 112. Growth rate of earning is expected to be 5% perpetually. Perpetually means forever. Calculate cost of equity. Observe here, you do not have data about dividend, but you have data about earnings. That means, sir, 1,50,000 earnings. If I divide by number of shares that I have, how many shares I have? 10,000. What I get is EPS. Able to follow? Yes. Now this question is not based on dividend. This is earning. But sir, there is growth also. Yes. Instead of taking it as dividend growth, you have to take it as earning growth. Guys, how can I do dividend here? Because there is no information at all. Sir, we will assume dividend as 100% of EPS. Dividend payout ratio is full. Then whether you do EPS based or DPS based, how will it make a difference in the answer? Anyway, you are counting same 15 rupees dividend also. Correct? But be careful. All of this is current data. But your formula is E1. When there is a growth, it can't be E0. It should be E1. That means I should not take 15 rupee. I should take 15 plus 5% growth. 15 plus 5%. I am also doing in Calci. I am getting 15.75 numerator to be divided by today's price 112.140625 plus there is 5% growth. 5% growth is 0.05. That means it is 0.1906, which is 19.06%. Hope you are understanding. Yes, there is no 1 minus t, there is no taxes. You are talking about equity share. Yeah, let's move on. Question 25. Generally, cost of retained earnings are taken as equal to cost of equity. Do you agree with this statement? Cost of retained earnings are taken as equal to cost of equity. Answer is yes. Sir, this may not be always, sir. If there is flotation cost, if MPS is given, correct, your points are valid. But read the question properly. They said generally, can I take KR, cost of retained earnings, KR is equal to KE? Generally, I can take, there is no problem. But is it always true? Answer is no, it's not always true. Yeah, those who are thinking, sir, I can say partly true, partly false. Guys, read properly. They have used the word, first word itself is generally this is KR equal to KE. Therefore, I can say true. Yeah, imagine in exam, if the word generally is not there, then you can say, sir, this statement is correct. Sometimes it is incorrect, sometimes. I hope you're understanding. I hope you're understanding. But what if they say, always we take cost of retained earnings as cost of equity? If they use the word always, then I will say it is false. I hope you're understanding. All of this is happening only because of that one word, generally. If they say always both are same, I will say, boss, it is wrong. It is wrong. I hope you understood. You are not wrong when you say option C, but you just have to think and read properly. And in exam, whenever you want to tick partly true, partly false, be careful. Partly true, partly false, be very careful. Yeah. Okay. Chalo. I am winding up this session here. We have completed 25 questions in cost of capital. I have lot more questions for discussion, but because it's already late, I'll have to close it here in this session. In my next session, we will start with cost of capital itself. We'll start from question 26. I have kept another, you can see here, total 47 questions for cost of capital, and we're done with only 25. So I have 22 more questions waiting. only from this topic. Yeah, we will complete that first. Only after that we will start with dividend decision and capital structure in the next session. So next session, completion of cost of capital plus dividend decision plus capital structure. Dividend decision is anyway a very small topic, so it won't take much of time. So that time that we are going to save, we will use it for cost of capital. All right. Sure. Very good. I hope today's session was helpful, useful to all of you. Yes. And those who are not from our regular batch, if you wish to take up our financial management class, my complete FM class is available on yashasacademy.com website. The description to buy will be shared in the description. The link to buy will be shared in the description, and we are running a special offer for next 3 days. So you can buy it at 15% discount. So yashasacademy.com is the website, and you can check out here in the shop section. You will get the information about CA Intermediate Financial Management batch, whether you're writing in May 24 or November 24 or afterwards also. You can buy this. This is as per new syllabus itself, and all classes are in 100% English. Okay, chalo, thank you so much. We will meet again in the next session. We'll continue with cost of capital, and please do your homework on dividend decision and capital structure and watch my next session. Thank you so much. See you again. Till then, take care and bye. Bye.